If you've recently decided that it's time to buy a new house, but all the news about the real estate market today is intimidating to you and you don't know where to start, then I created this home buying video for you. Hi, my name is Tracy Williams. I'm a licensed loan officer with Norcom Mortgage in Glastonbury, Connecticut, and it would be my pleasure to help you buy a new home. Let's review the process. Buying a new home is the single largest financial transaction most people will complete in their lifetime. That's why it's important to be prepared and to know what to expect. The home buying process can be broken down into 9 or 10 steps, starting with getting a handle on your finances, your credit report, um, finding a real estate agent, defining your target search area for a new home, getting approved with a lender, actually making an offer on the home, having the home inspected, appraised, ultimately closing on the sale and moving in. And throughout this video, I'm going to talk a little bit about each step in the process to help you understand what to expect when. So the first question is, how do you know when you're prepared to buy a house? Outside of having stable or increasing income for the last 2 years, or you're a recent graduate working in your degree field, there's a couple other things that will indicate to you that you are prepared. You know your credit score, you've reviewed your credit reports, you've taken care of any discrepancies, you're paying your bills on time, you've saved some money for a down payment, or you have access to down payment funds, maybe through a gift from a relative. And you know that you have the time to look for a property that suits your needs. You've researched locations, you know what kind of house you want, and you have a little bit of an idea of what your budget is. And for the rest of this video, I'm going to help you determine all of those things. And so by the end of the video, you'll have a roadmap to get yourself financially prepared to buy a new house. The best place to get started is to talk to a mortgage lender like me. I will look at your income, your debts, your credit score, and your assets, your savings accounts and such, to help determine what your financial profile is. And then I will use this information to determine what kind of mortgage loan is a good fit and come up with an amount that you can realistically afford that is comfortable for you to make the monthly payments. The first thing we have to overcome is the credit. And how do you find out your credit score? Well, you can wait for me to pull it and we can review it together. Or before you talk to me or someone like me, you could go to a website called myfico.com. You'll pay a little bit for it, but this is the actual style of report that a lender will pull. And you'll get reports from each of the three big credit bureaus. You'll want to look for inaccuracies, any frauds, any late payments and stuff like that. And you'll want to clean up anything that doesn't look right, but then you'll also know kind of where you stand. If your score is less than 640, contact me. I can put you in touch with a credit counselor who can help you increase your credit scores. Sometimes it takes a few months, so give yourself some lead time before you want to buy. And if your credit is good, you want to make sure that while you're going through the home loan process, you don't apply for any more new credit, no credit cards, car loans, etc. If you have collections accounts or charge-offs, you'll be tempted to pay them off. Don't pay them off right away because believe it or not, that could make your score go down. And don't consolidate your debts or close any of your credit card accounts. When you do this, it lowers the amount of your available credit and it actually will lower your score. If you have any questions about the best way to manage your credit and your credit report, contact me. Again, I can put you in touch with a credit specialist and they can give you advice on how to handle any issues on your credit report. Here's just a little graphic for you about the range of the FICO scores that mortgage lenders use when determining whether or not to approve you for a loan or what your interest rate is going to be. And you can see the scores range from 300 to 850, with the most excellent scores being in the high 700s to the top score of 850. Very good scores are in the mid 700s, above average, the low 700s. And once you get below the 680, then those require either special loan programs, or perhaps they're more expensive, or they have more strict underwriting requirements. So you want to try to keep your score above 680. If you've ever wondered what goes into calculating your credit score, here's a graphic that shows how the information in your credit report is used in the algorithm to determine the score. It's more than just whether or not you pay your bills on time. It's a combination of your payment history, the amount you owe, how much of your credit is recent, and how high your balances are in relation to the limits, and how long you've had a credit history. A mortgage is a very specific kind of loan that occurs when you give real estate as collateral for that loan. The lender then takes a security interest in the real estate, and that security interest is documented with a mortgage deed, and the borrower has then taken out a mortgage loan. The documents signed at the closing are recorded in land records in the town where the property is located, so that there is a public notice of the lender's security in the property, which is notification to future parties down the line who may be searching what we call title, to make sure that there are no outstanding ownership issues. When you borrow a mortgage loan, you will be required to make monthly payments until it is paid off, and that payment is determined in a formula using the loan amount, which is the amount you borrow from the bank, the interest rate, and the term of the loan, which is the length of the loan, usually expressed in a number of months. Lenders usually use the term housing payment, which also includes, in addition to the loan payment we just spoke about, it also includes homeowners insurance, real estate property taxes, mortgage insurance if it's applicable, and if you live in a condo or a PUD, homeowners association fees. And all of those items together make the total monthly housing payment. And lenders use this housing payment to determine how much of your income is devoted to housing expenses. Most of our underwriting standards have a limit to how high the ratio of your housing expenses to your income can be in order to be improvable. Underwriters analyze a series of criteria to determine if lending standards are met to approve a mortgage loan, and payment ratios are just one of these criteria. The five main pieces of information that lenders evaluate to determine if you are approvable for a loan are your income, the gross amount of money you make on a monthly basis, your debts or liabilities, which is the amount of money that you're obligated to pay to others every month. And examples can include your car loan, your student loans, credit cards, alimony, and anything you may have co-signed for other people. We look at your credit score, which we refer to as your FICO score, which is a numerical expression of your credit worthiness. And we look at the collateral, which is the value of the property, the condition of the property. Every loan program will have a maximum loan amount available versus the property price or property value, which we call the loan to value ratio. The difference between the loan amount and the purchase price is referred to as the down payment, and that amount you will have to pay in cash at the closing, or you will be able to possibly be able to borrow another loan called a down payment assistance loan. The last item we look at are your assets, and these are your cash balances in savings, checking accounts, money market accounts. It can also include investment accounts and retirement savings. and any funds you'll be using for the down payment and the closing costs, such as gift money that you might get from a relative. Speaking of closing costs, what are they? Every loan transaction has fees that are required by the lender. We have underwriting fees, processing fees, appraisal fees, credit report fees, and all of these things are very typical for every lender. Some borrowers will also choose to pay a fee up front in exchange for a lower interest rate. That fee is usually referred to as discount points. You will also have to select an attorney to conduct the closing. The attorneys charge fees for their time to prepare the documents, to search the land records we talked about earlier, and to conduct the settlement. A lender will also require homeowners insurance to be paid up front for 1 year and have funds deposited into an escrow account to pay for taxes and insurance that are due after the closing. All of these things together are your closing costs. I just mentioned escrow accounts. So, what is an escrow account? It's essentially a savings account that the mortgage lender keeps for you. We'll collect 1/12 of the amount of property taxes, homeowners insurance, and mortgage insurance that you pay every year. And when those amounts are due, the lender pays them for you from that savings account. If you borrow 80% or less of your purchase price, oftentimes you can ask the lender to waive this requirement and pay them on your own. At some point in the loan process, you may be told by your lender that you are required to buy mortgage insurance. What is that? Many loan programs insured by private insurers require the borrowers to buy this type of insurance when the loan amount is more than 80% of the purchase price due to a higher amount of risk involved when there's less equity. Lenders require this mortgage insurance to protect them in the event you do not pay your mortgage loan and the loan goes into default. It does not protect you, and it will not prevent foreclosure if you stop making your loan payments. Most loan programs insured by the government have some sort of insurance or guarantee fee requirement regardless of the amount borrowed. There are several different types of mortgage loans, and each will be more appropriate for different borrowers based on their features and benefits. It basically breaks down to loans that are insured or guaranteed by federal government programs and other loans, which are called conventional loans. The conventional loans are typically loans that are sold to institutional investors, private banks, etc. And you can see from the graphic that the down payment requirements are different. There are conventional programs that require as little as 3% to 5% down. The FHA always requires 3.5% down. USDA is a 0% down loan program. You can borrow 100% of the purchase price. The catch there is that they are for properties located in rural areas, so you have to be located in a specific um, rural location in order to qualify for USDA. And VA, again, are 100% loans, but only available to eligible veterans. Credit score requirements are different based on each loan. Some of them have other underwriting criteria that differ slightly, debt to income ratio limitations that are different from each other. They all will require some form of mortgage insurance or fee. The difference is with the conventional loans, that only applies if you borrow more than 80%. But the FHA, USDA, and VA loans all require some sort of guarantee fee. The most common loans that we see in our office are either FHA or conventional. So I have a graphic here that highlights the major differences between FHA and conventional. Basically, FHA is a government program designed to encourage and promote homeownership. So they make them a little easier to qualify for by allowing lower credit scores, higher percentage of your income attributed to your debts. They require only 3.5% down. The flip side is that the mortgage insurance is required for the life of the loan, and they also allow up to a 6% seller concession, which means the seller can contribute 6% of the sales price toward your closing costs. On a conventional loan, the credit scores required are a little bit higher, and some programs require 5% down. But the mortgage insurance, once you pay the loan down to 80% of the original value, the mortgage insurance goes away. So it's not permanent like it is with FHA. There are more mortgage insurance payment options with a conventional loan, but they also only allow seller concessions on a tiered basis based on the loan to value. And so most people who are borrowing, 95% of the sale price would be limited to a 3% seller concession versus the 6% on the FHA. So the next couple of screens illustrate the differences in the monthly payment calculations for a couple of different kinds of loans. We did an FHA loan with 3.5% down and two conventional loans, one with 5% down that required mortgage insurance and one with 20% down that did not require mortgage insurance. We used the prevailing interest rate for each loan at that loan to value based on the rates on December 20th, 2021. We used average credit qualifications like credit score and debt to income ratio that were consistent for all of the loans, so that the only difference between the options were the actual options themselves. All other factors stayed the same as far as credit qualifications. The first example was purchasing a condo that cost $184,900. And you can see the difference in the down payments. The FHA was 3.5% down, and then two conventional loans, 5% down and 20% down. And you'll notice immediately that the loan payment, the principal and interest payment, is lower for the FHA loan than it is for the conventional loan, even though the FHA loan balance is higher. And that is likely because the interest rate on the FHA loan was lower, which is typical between FHA and conventional loans. The other portions of the payment, the homeowner's insurance and taxes and the homeowners association fees, are going to be the same for each one. The only difference then being the FHA mortgage insurance and the conventional loan with mortgage insurance on the 5% down. There is no mortgage insurance on the 20% down conventional. So you can see the total monthly payment, the FHA loan payment being the highest and the 20% down conventional being the lowest. Here again, another example of a family house costing $350,000. The cost breakdown for an FHA loan and the two different conventional loans. Curious that the FHA and conventional loans are very similar in cost, with the 5% down conventional and the FHA, and of course the 20% down conventional with no mortgage insurance and a lower loan amount results in the lower payment. So where should you start? Well, the first thing you need to figure out is how much you have saved that you will be devoting to the transaction, how much you might add to your savings before you actually get to the point where you are ready to purchase a house. And this includes knowing how much funds you'll receive in a gift if you're going to be getting a gift money. And then you should consult with a lender to determine your budget. Be prepared to answer questions about your income, your employment, your savings, and then discuss with your lender pre-qualification and pre-approval, and ask them to recommend realtors to you. And you might find the following timeline to be helpful. You'll want to get started could be 6 to 8 months, because you may have some credit issues you need to clean up. This market has been very competitive. It takes sometimes several months to find something because there just isn't a lot out there. You'll want to be doing some research to determine where you want to live, what kind of house you want to buy, Um, and then about 6 months out is when you're going to want 3 to 6 months out, you'll want to start talking to your lender about getting pre-approved, find an agent, start your hunting. Um, and then the rest of it is, after you've found a house, and it takes about, 45 to 60 days to complete the process. What is a pre-qualification? Well, once reviewed your credit report and evaluated your monthly debt obligations and the income that you have reported to us, we can determine a monthly housing payment and a loan amount that is comfortable and would likely pass loan underwriting standards. Once we identify this loan amount, we add your reported savings balances for a down payment and arrive at a house price you can afford. Then we will write you a pre-qualification letter. This letter lets the seller of the property know that a lender has reviewed your qualifications and that you have a preliminary indication that you would be approved for a mortgage on the terms shown in the letter. Many sellers will not entertain an offer on a house without this pre-qualification letter, and many realtors will not even take you to see houses without one. That's why this is an important first step. How is a pre-approval different, and why would you need one? Well, a pre-qualification review is a review of your qualifications based on what you tell us about your income and assets. A pre-approval is fully underwritten and reviewed by our underwriter with complete documentation that verifies your income with pay stubs, W-2s, and assets with bank statements. You'll receive an actual loan approval commitment letter that is conditioned upon finding a suitable property. This type of lender review tells the seller and the realtor that you are already approved for a loan pending review of the property. It eliminates the uncertainty of a mortgage approval, and it makes your offer to buy very strong. And it's a really good strategy in a highly competitive market like today. You found a house. Now what? Well, once you've found a home and made an offer that is accepted, you will send the lender your purchase contract. This triggers a regulatory loan application process, and you will receive a disclosure packet with information about the loan that you have applied for. It includes the estimated terms, the closing costs, your rights in regard to the information you provide to us, and that we must provide to you. We will order an appraisal of the property to verify the condition of the property and that the purchase price is reasonable compared to similar homes. We may, at this time, ask you for additional paperwork as needed to keep the file current and verify any other new information that comes up. Your realtor at this time will also review with you the home inspections that are available to you so that you can be sure there are no issues with the property. Some loan programs will actually require certain inspections like a well water test or a termite inspection. And then your lender will also ask you to choose a closing attorney. We can make recommendations based on our experience in your area. An attorney will search the town property records to determine there are no outstanding issues with property ownership and begin to prepare the deed to transfer the ownership to you. Lastly, you will be required to buy homeowners insurance, at least in the amount of the loan balance. You'll be required to pay for a full year up front, and then the lender will set up that escrow account for your insurance and the taxes for the amount that's due after the loan closes. You should always be prepared for a new request to explain something in the documentation that's been provided or to send in additional documents as underwriters review the file and questions come up. Lenders have documentation standards that we have to meet, and we are reviewed and graded by our investors on how well we have done that. So that is why lenders will always maybe ask for that one extra little piece of paper just to make sure that they can prove that they did their due diligence. Once your loan has been approved and all the supporting paperwork is filed and signed off on, your loan will be cleared to close, and we will contact your attorney to schedule the closing. At least 3 days prior to the closing, you'll get what we call preliminary closing disclosure, showing you the closing costs and the amount of cash, estimated cash, that you will need to bring to the closing. These figures often change once the attorney provides final adjustments for items that the seller has either paid in advance or items that they owed to be paid, such as utilities and taxes that they've used some of, but the bill hasn't come due yet. They make adjustments at the settlement for what portion is going to be attributed to your ownership and what portion is theirs. So anything you get from us prior to that adjustment being calculated is just an estimate. The day prior to the closing, after the attorney's office and the lender verify all the closing costs and balance the figures, you will get a final number from the attorney's office for the cash to close. You will have to bring a bank check to the closing for that amount. Then you show up to the closing, sign the closing papers, and receive the keys to your new home. If you would like more information on the mortgage loan process or anything to do with banking and consumer finance, here are some helpful resources, some websites that I have listed for you where you can get some really good information. The consumerfinance.gov has a great explanation on mortgages and banks and lenders and explains a lot of stuff. So does the FDIC. They have a whole money smart, responsible financial management curriculum. Really great information. If you want a free credit report, you can go to annualcreditreport.com and you'll have access once per year to pull the credit report from each of the three big credit report agencies so that you can monitor your reports and make sure there's no errors in them. And then the last website I listed is Bedrock Credit, and that is our friend Stephen Robert, who is a credit counselor, and he is fabulous and gives great advice if you find yourself in a situation where you need to talk to somebody about your credit report. He's great, and I highly recommend him. So that the end of my Home Buyers 101 presentation. If you have any questions, if you are ready to apply or you want to talk to somebody about getting pre-qualified and just figure out what your budget is and set up a process where we can work together over the next several months until you're ready, please reach out to me. My cell phone, my email is all listed here, and be more than happy to help point you in the right direction. Good luck with your house search, and I hope we can work together.